If you have a good salaried job or you have a nice little nest egg, I think one of the most irresponsible things that you could do is go out there and start a side hustle or some sort of business where 9 out of 10 fail within their first 10 years. Instead, what I want to show you is a strategy that is extremely boring, but in my opinion, yields way better results and chances of success as opposed to starting an online business or a side hustle. And drop a comment down below. I'm also going to give you my early retirement strategy guide completely for free, no opt-in or anything like that. And hit that like button and that subscribe button while you're down there as well. And of course, I hope you are having a God blessed day. Let's go over the shoulder. I'm going to show you a strategy, and this is perfect for those of you, like I said, that are high earners. Maybe you have a big nest egg. You want to get into some sort of side hustle or online business. Well, I believe this is the ultimate quote unquote side hustle that really takes 15 to 20 minutes of your week, if that. Let's go over the shoulder. So this strategy entails us saying we're willing to buy 100 shares of a stock at a certain price on a certain date and get paid a premium income upfront just for saying maybe. That sounds crazy. I went over that real quick. Let me show you a live example. Let's say you want to buy 100 shares of Apple, my friend. Okay, well, guess what? You can do that. You can go out there on your Robinhood app, on your Fidelity, on your Schwab, and just drop $27,000 and have 100 shares of Apple at a cost basis of $270. Fantastic. That's what most retail investors do. That's what the 99% of people do. Nothing wrong with that. And guess what? They hold on to it. They hold on to it for a year. And let's say you bought some last year. Apple is trading at 245. Now it's trading around 270. Okay, you made a little bit of money. Let me show you a better way to do things, right? Let's go to the options section. Don't click away. I know you hear options, you're scared, you've lost a bunch of money. I have too. Drop an amen if you lost money with buying options, because your boy has. All right, what we're going to do is we're no longer an options buyer. We are an options seller. So right here, all I'm going to say is sell, put, okay? All I'm saying here is now I'm willing to buy 100 shares. Okay, now I get to pick the date that I'd be willing to buy those 100 shares. And I like to usually go out around 30 days. So I'm going to go to December 5th, 34 days away. I'm willing to buy 100 shares of Apple at close on December 5th. Next, I get to name my price, baby. Right? I get to say at what price I'd be willing to buy 100 shares of Apple at close on December 5th, if it is at that price. Okay, 260, 255, 250. Okay, well, let's see these 260s right here. Well, if we did the 260, if we'd be willing to buy 100 shares of Apple, if it's trading at $260 at the close on December 5th, I would collect at the time of me recording this, $335, a little bit more. We usually like to be between the bid and ask spread, but for the sake of this example, we'll just say $335, right? That is coming from an options buyer. You can see it says estimated credit. That is given to you from an options buyer, right? Now, your brokerage is going to lock up $26,000 of yours for this, because there's a few things that can actually happen. So let's map out the whole trade here with my cash secured put calculator. All my calculators, trade logs, covered call calculator, all that good stuff is free. Plus you get a free 2-hour training on the Ark Options Strategy. Second link in description of today's video. Definitely go check that out after today's video. So what did we say? We're collecting $335. We're locking up $26,000 of ours, and we're getting a percent of 34 expiration date of 34 days. We're locking up our money, and we're getting a 1.29% return on our collateral, right? That's $335 divided by $26,000. Now, of course, you can do multiple contracts. So let's say you did have a big bankroll and you did 5 contracts. Well, that would lock up $130,000 of yours, but you would collect $1,600. Okay, let's talk about the risks. Obviously, nothing here is financial advice. Results vary. This is just what I'm seeing on the options chain when I'm showing this. Okay, couple things. 2 big outcomes can happen here, right? Let's say at close on the 5th, Apple's trading at 270 still. Anything above 260. Well, guess what? It's not trading at 260, right? So you're not buying your shares. Your collateral, your money that was wrapped up to buy those shares is returned back to you by your brokerage. And you can then go run the play on another opportunity, collect more premium, and continue the compounding effect, right? Making your money work harder for you. The second thing that can happen, and this is the biggest risk of this strategy, is that let's say at the close on the 5th, Apple's trading under 260. Let's say it's trading at 255 or 250. Well, you are buying your 100 shares at $260, right? So your money, your $26,000 will not be returned back to you. It'll be used to buy 100 shares at $260, and your cost basis, you're going to be given 100 shares of Apple at a cost basis of $260. Is that worth it? Is it not? You got to make those risks. You got to take those risks for yourself. For me, I like to look at this as a source of income. So for me, I'm okay with either outcome because I'm collecting that income, essentially lowering my cost basis anyway. Now, the closer you go to the current share price, let's say 270, the more premium you get because you're taking a larger risk. It's more likely to happen. Okay, so for example, the 265s, we collect $485 if we said we'd be willing to buy it. If 270s or the 270 strike, we're collecting $685. Essentially, we're kind of insurance salesmen in a way, if you want to look at it that way, right? With that said, there is a way to check your probability of assignment, right? Meaning the chances of you actually having to buy your shares. Now, it's all BS. I'll be the first one to tell you. Nobody knows what a stock is going to do. No technical indicator, none of this stuff. No Greek is going to tell you exactly what's going to happen. But it's a good place to build a thesis around doing something so you're not just always going in blind, okay? So, for example, if I open up that 260 that I showed here, you can see the delta is a 0.27. Let's just call it 0.30 for simple math, okay? That means it's a 30% chance that I'm going to have to buy my 100 shares of Apple on the 5th. However, I like to look at it the other way. 70% chance of not getting assigned. That means I'm not going to have to end up buying my shares of the stock, right? Absolutely fantastic, right? That's the way I like to look at it. Now, what is the right delta? What is not? Well, that's a decision you're going to need to make. I like to be around that 0.25 to 0.230 because I don't mind getting assigned, as you're going to see here in a moment. But with that said, the closer we get to the current share price, you could see the 265s, there's a 36 delta, so 36% chance of assignment. The 270s, 46% chance of assignment, basically 50-50, right? So, right, obviously the lower the share price you go, the more premium you're obviously going to collect, okay? Now, if we get assigned shares, what we can then do is put our shares to work. Right now, we're just putting our money to work more for us. But what we can do when we have 100 shares of a stock or an ETF, what we can then do is flip the script and use our 100 shares to run something called a covered call. So what that means is all I'm doing is flipping from put, selling a cash secured put, to selling a covered call. Now, to do a covered call, one contract is equal to 100 shares. So you need to make sure that you have at least 100 shares of a stock or ETF that you're planning to run this on, okay? But with that said, let's say our cost basis for our 100 shares of Apple is 270. A lot of people, what they will do with this strategy I'm sharing with you is they will do exactly what I'm about to show you. They will go out there and buy 100 shares of Apple at the cost basis of $270, $27,000. They'll put $27,000, they'll buy 100 shares, and they'll immediately do what I'm about to share with you. They'll take those 100 shares and then say, I'm willing to sell them for $280 in 30 days from now, right? So if they did that, right, in this specific educational example, they would collect $390 of premium from the options buyer, right? Now, let's toss that into my covered call calculator. Again, these calculators are free. Second link in the description. What did we say? We're going to collect $390 of premium here, right? $309. Our strike of option, that is what we're willing to sell our shares for. We said 280, right? We said the 280s, right? So 280. We bought our shares, 100 shares at the current market value of $270, right? And our premium return here is a 1.44%. Right? That is 390 divided by $27,000. And you can see that's a premium return of a 1.44% in a single month. Now, what are the risks on this side of it? Well, the risks are you are essentially capping your upside with this. Let me explain. First of all, let's say the 5th rolls around and Apple is trading under $280, right? It's $279, $278, whatever, anything below $280. Your shares aren't sold, your shares are returned back to you, and then we can run the play again the following month to collect some more rent. I like to look at it like renting out my shares. But let's say on the 5th at close, Apple is trading at $290. Well, guess what? You've capped your upside and you're selling your shares at $280. You are going to not get your 100 shares back. You are instead going to get an extra $1,000, right? Because your profit on the shares is $1,000. That's the difference between $270 and selling them at $280, right? For a total profit on the full trade of $1,300, right? Now, obviously, this isn't even accounting for the cash secured put that it took to assign. Now, what do we do at this point? Now, our 100 shares are gone, right? Our 100 shares of Apple are gone. Now, what do we do? Well, we rinse and repeat. We rinse and repeat. We go back to our options chain. We click sell now, a put, because now we've got $28,000, actually closer to $29,000 if we factor in the premium. Now we can go and sell another cash secured put using that money that we just got from selling our shares immediately, saying, for example, if we wanted to continue to do it with Apple, you know what? I'm willing to buy it at $270 now, right? Boom, collect more premium, rinse and repeat the strategy. This is called the wheel strategy, and I've over-engineered the wheel strategy because I turned it into something called the Ark Options Strategy. Now, the reason I call it the Ark Options Strategy is because I combine 5 sources of premium. I just showed you 2 right now called the cash secured put and the covered call premium. What I actually like to do as well is run this on dividend paying stocks, right? That way I'm collecting a dividend on top of my covered call premiums, essentially manufacturing a dividend, right? And then if I sell my shares, I capture that appreciation profit as well. And secondly, right, what I like to do with my cash secured puts is use brokerages that pay me about a 4% interest rate at the time of me recording this while I wait to buy stocks. And you could see that in my trade log. Now, you know, your ROI on your collateral is going to be totally dependent on what your specific goals are. I'm not a financial advisor. I'm just documenting my journey here and sharing this message that I believe everybody should know. But with that said, so you can be more aggressive. You could see on my live trade log, you know, I have some very risky trades where I did, you know, cash secured puts where I'm getting almost a 5% return on my collateral. Remember, this premium isn't free, okay? Even though we're kind of collecting income up front, when you're going into territory where you're getting like 3, 4, 5% ROI on your collateral, you're taking on risk. That's a much higher chance of something going sideways on you. So you need to be prepared for that. Now, with this strategy, I always say stick with it with a year. I showed you a simple approach as a busy person, right? That can just, you know, open their trades once a month, check, open up their trades and move on, collect their income. But you could take this to the next level, just like anything in life, where if you spend just about literally 15 to 20 minutes to an hour a week, you can actually manage these positions and get in and out of them faster, freeing up your collateral or your shares faster instead of waiting all the way till that expiration date, till that December 5th, right? And you could see that I do that a lot early. And in fact, on my trade log, 54% of the time, I have closed my positions out early. I've closed my positions out early. That means I didn't even let them go to expiration. I closed them out early. 15% of the time, I rolled them out to a different strike price to capture more appreciation profit. And sometimes I even got assigned my shares and called away, means 15% of the time, my shares got sold and I captured that appreciation profit. So if you want this full trade log plus the calculators, click the second link in the description of today's video. You're going to get a 2-hour training on the Ark Options Strategy. And don't forget, drop a comment down below. I'm going to give you my free ebook, my early retirement strategy guide. I can tell you guys, this and people in my community are using this as their retirement income. And that is my plan as well. I believe this is extremely lucrative and it's not something that requires us to be glued to charts all day long. I don't know about you. That would make my my head spin. And that is surely nothing I want to be doing during my retirement years. I need something that's scalable, something I can stick with. I call this the last investment strategy. I'm not a trader. I'm an investor. And I believe, you know, having a good buy and hold portfolio that you buy on a weekly or monthly basis, absolutely. Set, forget, of course, recommend that. But for me, I treat option selling like a business. My point is to make money, reinvest that money, and compound way faster. So go ahead, click that second link in the description of today's video. Watch the full Ark Options Strategy workshop. And remember, guys, sell options, collect premiums, repeat. I'll see y'all tomorrow.